Hello everyone, my name is Maadhav Poddar. I'm an Associate Director with the Tax and Regulatory Services practice and specialize in the real estate and infrastructure sector. The agenda today is to give you an overview of the Infrastructure Investment Trust regulation proposed in the consultation paper issued by the Securities and Exchange Board of India in December of 2013. We at EY have analyzed the tax and regulatory issues in this video. In the US, the UK and Singapore, an investment trust vehicle has gained significant traction and has been the vehicle of choice for channeling capital into infrastructure. Securities and Exchange Board of India has acknowledged usefulness of such a vehicle in the Indian context with a view to A. Provide financing and refinancing opportunities to infrastructure developers for their projects. B. Channel long-term domestic and foreign capital towards equity for the sector. And C. Reduce exposure of the Indian banking system to the sector. We believe that infrastructure for this vehicle should include transport, energy, water sanitation, communication sectors, and certain social and commercial infrastructure asset classes such as hotels, hospitals, educational institutions, and warehouses. There are two broad categories identified, A. Mutual fund and B. under a separate framework. The current guidelines provide for at least 90% of net distributable income after tax to be distributed to investors across all categories. The mutual fund format needs to have a mix of constructed and under construction projects, but restricted to a single infrastructure subsector. Example, a hospitality infrastructure trust would be restricted to invest only in hotel assets. While listing of such mutual funds is not mandatory, there has to be a minimum 65% allocation towards equity instruments of special purpose vehicles holding infrastructure assets. On the other hand, there are Category 1 trusts which are aimed at institutional investors and will serve as a captive investment vehicle for them. Again, listing is not mandatory in this category. Category 2, however, is designed for retail participation and therefore can only invest in completed assets and has to have a minimum public float and has to be listed on an Indian stock exchange. This is a detailed structure diagram for a mutual fund, and the key highlights are A. The trust should have a minimum of 76% equity in each of the special purpose vehicles. B. There are no gearing limits. And C. There would be a lock-in of 3 years for the initial foreign investors. Here we've provided an overview of tax consequences of proposed structure under current law. At the time of setting up the structure, selling shareholders will be liable for capital gains tax, and any tax net operating losses would lapse as a result of change in shareholding. Continuity of tax holidays would need to be analyzed in case of asset transfers. The SPVs would continue to be liable for corporate tax or minimum alternate tax. To the extent of distribution of interest, there would be a withholding tax and a dividend distribution tax in case of dividends. The income of the trust itself would be exempt from tax, and any distributions to unit holders would not be subject to a withholding tax and would also be exempt for investors. In case of listed mutual funds, the unit holders will be exempt on long-term capital gains, which is not available in case of unlisted mutual funds. This is a detailed structure diagram for a Category 1 trust. The key highlights are A. The trust should have a minimum of 15% equity in each SPV. B. There are no gearing limits. And C. Issue to be privately placed with institutional investors with a minimum ticket size of Rs 50 million. This is a detailed structure diagram for a Category 2 trust. The key highlights are A. It has to be listed on an Indian stock exchange. Maximum gearing is limited to 50% of net assets. C. The ticket size is a minimum of 1 million rupees. Here we have provided an overview of the tax consequences of both Category 1 and Category 2 trusts under current law. At the time of setting up of the structure, as also the tax position of the SPVs would be the same as described in case of a mutual fund. However, unlike a mutual fund, the trusts in these cases would be taxable and unit holders will continue to be exempt on distributions received from the trust. Trading of units would also be taxable for unit holders. Concessions have been sought by the industry to provide a stimulus for these investment vehicles. This includes an exemption from capital gains for initial setup and continuity of tax NOLs and tax holiday benefits at the SPV level. Also, the multiple layers of taxation at the SPV level, trust level and unit holder level make these structures unattractive. The industry has therefore sought for a single point of taxation. Further, for unit holders, an exemption from long-term capital gains tax across all formats. We hope you found this analysis useful. Look forward to getting your feedback and comments.